This is step 2, identifying the separate, I'm sorry. If I only knew how to edit. This is step 3, determining the transaction price. So step 3, determining the transaction price, we're going to add a lot more detail to it. We know that the price is, they refer to as the amount of consideration that the company expects to receive as a result of selling some goods or services. The easy situation is, the customer, buys something and pays for it in a reasonable time. But there's a lot of complicating factors to this. Nothing's ever easy. So complicating factors are going to be variable consideration, the time value of money, non-cash consideration, and consideration paid or payable to the customer. These are things that have all been part of revenue recognition before. It's just the terminology and the sort of the concept behind them are different. A lot of the journal entries are not appreciably different. So let's start with variable consideration. This is where the price depends on something that's going to happen in the future. So maybe the customer will take a volume discount, maybe they won't. Maybe there'll be a rebate, there might be some credits, there might be performance bonuses or royalties. So these are things that are not certain right now. So there's 2 methods to estimate. One is the expected value, and that's where we use the probabilities to determine, given a series of outcomes, what's the probability of each, and then we come up with a probability weighted amount. The other is you kind of go through the same thing and you just take the most likely amount. You're going to use the expected value when the seller has a fair amount of experience in the past and has reliable past data to go on. Then they've got the information to do this. Most likely amount would be if, say, you didn't really have the experience in it, and you're just going to go for the most likely amount. So let's take a look at this. Doing the expected value, if we contract to build a warehouse for $100,000, but there's a bonus of $150 if we complete it on time. So if it's on time, we're going to get $150, $150,000. And there's a 60% chance, based on past experience, that will happen. So we would go 60 times the 150, 90. But then if we're a week late, they're dropping $5,000 a week apparently if we don't get done on time. So the bonus would only be 145. We'd only get 145. There's a 30% chance of that and a 10% chance of getting the 140. So you would add them all up, and the amount of revenue you would recognize would be the 147,500 because that's the weighted probability, most likely amount you're going to collect. If you're just using the most likely value, you just take the 150 because there's a 60% chance that you'll be completed by then. So that would be what you would do if you didn't really have the experience of doing this before, so that would be the most likely value. Okay, so revenue, they use the word constrained. That just means we don't recognize it. If you really can't predict what's going to happen, if the amount you're going to collect is, it depends on the market, it depends on something someone else is going to do, the weather, all kinds of stuff like that. In other words, if it's reasonably certain you're going to collect the revenue, you can book it, but otherwise, no. Okay. And the other would be if the company's experience with that is somewhat limited. Okay, so that's some of your variable considerations. What I would recommend is working through the brief exercises on that, and then that gives you a solid basis on how they work. Okay, so now the next thing that complicates coming up with step 2, which is step 3 rather, which is determining the transaction price, is the time value of money. This you already know. So if you're not, if you have extended payment terms, you can't call the interest revenue. So basically you have to take the interest out and the transaction looks like this. So if you have they sell the goods for $900,000, but they're going to give a note for 1.4 and change. You know that this 1.4 is not all revenue because it is a 4-year note, and so some of that is composed of interest. So we do the note receivable for the full amount. We only book the sales revenue for the amount of the actual goods that were sold, and the rest is the interest factor, which is the discount on notes receivable. So we do the cost of goods sold inventory, and then at year end, we're going to recognize some of the interest that's happened on that note between July and the end of the year. So we take the 900,000, okay? This has the interest in it. Don't use that number. 900,000 is where you start. 900,000, 12% interest, they give us the implied rate, and then times 6 months because we started in July here. So this would be, the discount would be reduced and interest revenue. And if you carry that out the full 4 years, then you would end up with the cash would be collected in this amount. Okay, you'd end up with everything fully, basically amortized there. Okay, so that's, we're still working on determining the transaction price, time value of money. The next thing we come to is non-cash consideration. And this also, these are treated the same way as they were under the old. It basically, if you have contributions to your company or some kind of non-cash consideration, you need to arrive at the fair market value of that non-cash consideration in order to record revenue on it. And contributions must be recorded as revenue. And it has to be at the fair value. So if we look at the example here, and these are fictional numbers, let's say GE decided to relocate in Boston. The city agreed to pay 20% of the cost of the building, and the building was completed and everything was paid. So the building cost $20 million. The city of Boston contributed $4 million to that. I don't know if they did this or not, but this is just an example. I know GE did come to Boston. Okay, so the building goes on the books at $20 million. Cash was expended of 16. This contribution revenue must be booked for the donation that the city made to the company. Okay, they can't just put the building on at 16. So this has to come on at the fair value, and that contribution is recognized as revenue. Okay, so this is just one more complication to the transaction price. All right, so the last one, that's a complication of that, is consideration paid or payable to the customer. And this is where you have discounts or volume rebates, coupons, other things like that. And they tend to just reduce the transaction price, but you have to be aware of them. I think the best thing to do is I have down to look at brief exercise 1812, and I'll probably do a separate video on some of these brief exercises that you could follow up to this with. Okay, so that takes care of step 3. And now we'll take a look at the last 2 steps.